What is a market correction and what does it mean for you? What's going on with the housing market and how does it affect rentals? Or should you rush into the market? Should you be buying stuff because they're on sale when the market drops? This and other questions we're going to talk about in this episode of the Affluent Entrepreneur Show. I will see you in the show. All right, welcome to this episode of the Affluent Entrepreneur Show. This episode, we're going to answer a couple of questions that came in from some of the members of the Affluence Blueprint. And I think that these are great questions, especially given the time that we're in and what has gone on in the market. I mean, question is, what do we do? Market's going down, market's going up. What do we do? How does it, how do we deal with the real estate market? And, when the market drops, should we be buying? And so I want to answer some of these questions. I'm going to read the questions so you get a flavor for it, and then we'll take it from there. And so the first is this. If people speak on market correction, what time frame are they referring to? The given market rises or drops every day, sometimes more, sometimes less. Is it when there is a drop of a certain percentage, 5, 10%, that makes it a correction? So great question. And yes, you hit it on the last piece. Market corrections are when the market drops 10% or more from the peak, its last 52-week high. Now, 10% or more would be a correction. 20% or more would indicate that we are in a bear trend, a bear market, although we want some repetition of it in there. So people will say, well, and we've seen ourselves very close to being in correction territory, and some individual stocks have dropped more than 10%. Some have dropped a lot. Let's just look at Netflix. Okay, so there are those things, but what does it mean for the overall stock market? I'm not going to talk about an individual stock, because here's the thing. When we talk about individual stocks, we need to understand what event triggered it. What event caused the drop? Is it market information? Is it earnings, missing earnings? Is it guidance? All those things impact. And is it a temporary thing? For instance, we've had stocks that have dropped, individual stocks that have dropped primarily because of the supply chain issues. Well, the supply chain issues are temporary. So as long as they can weather that storm, that time frame till the supply chain issues get resolved, that company's sound and it should come back. It becomes an event. But the other question is, if it's an individual stock, what happens? Is it an indication of a new direction for the company or a new challenge for the company, that maybe they are in trouble? And if that's the case, it isn't temporary. And so these are the reasons that at the very beginning, especially, the people that I work with in my master's program, the people that are part of the Affluence Blueprint, I tell them specifically, one of my 8 rules of investing is to not invest in individual stocks, not at the beginning. Not at the beginning. There is, yes, potential for higher returns because you can, if a stock decides to fly, you reap the benefits. But if a stock decides to drop, you get hit with the pain. And the fact is that if you it's that whole old adage, is you don't put all your eggs in one basket. If I put it on one stock, I'm waiting for that one stock to be the home run. And that's the thing that we need to be careful about. And so this is one of the reasons I say not at the very beginning, we don't want to go into individual stocks. Now I own, complete transparency, I do own individual stocks. But they're a very, very narrow and small piece of my portfolio. And I do that very strategically and for a specific reason, whether I'm investing for value or I'm investing for growth or I'm investing for dividends. I'm doing it for a very specific reason, but it was after I built the portfolio. So it becomes this very narrow slice. And when we talk about the market these days, it truly is a volatile market. Let's just look at, and you can just see, I mean, this is the 1 week on Dow Jones. I mean, this is worse than a roller coaster ride at Six Flags. Look at this, up and down, up and down. This is just 5 days, okay? And Nasdaq's the same way. Okay, that was the Dow Jones. Nasdaq's the same way. Look at it. Up and down. They all look the same. The S&P 500 looks the same. Bottom line is, we are in a volatile time, and there's uncertainty, and there's things about, like we said, about interest rates and about inflation. And I've got an episode coming out to talk about what do you do in inflation. We're going to do one on what do you do if there's a market correction. But I just wanted to answer these questions to start to understand that if we're in volatile times, and if we start to look at specific stocks, let's just look at Facebook, okay? This is the 1 week on Facebook, but let's just take it out. Look what it's done in a month. It's pretty much been down. It went to below $300 a share and was at one point at $370 something a share. Look at it. So point being is that if this was your only investment, think about the emotional roller coaster you are on, depending on when you got into it. And so this is why I say it's important for us not to invest in individual companies unless you're going to analyze them and spend the time, but you're still taking on an inordinate amount of risk because you're putting all your eggs in a single basket, So that's why we typically will say we want you in some sort of broad-based index fund, ETF, something that gives you the dynamics of diversification. You know, is it possible that you leave some returns and some gains on the table because you're not getting all of it, and some companies in the portfolio aren't doing well? Absolutely. But it is also when the companies that are doing bad, you don't lose as much. That's the reason behind it. Now, let's just talk about this whole idea about correction. I said it's 10% if it drops 10% or more from its 52-week high, whether it's the stock or the stock market, okay? And this happens, and people, don't realize it happens a lot. It happens regularly. And so this is something that we should expect. It's like letting the steam off on a steam cooker. It's not the same thing as a crash. A crash is typically a very steep curve. Let me jump here. So I'll show you this, but a crash is more of a steep decline this way instead of a gradual decline. Okay. And can a crash put you into correction territory? Yes, it can put you into bear territory, which is over 20% too. So it can. But this chart here, or this table here, if you will, that I got is the S&P 500. And I just wanted to give you a flavor so you understand that corrections are just part of the investing journey. Going back to 2015, here's a bunch of, these are the corrections that happened. But if you look at them, this is 12%, 10%, 11%, 11, 12, 14, 10, okay? But look at the length of them. They happen, most of them are short durations. You got 9 and 10 days here in 2016. Then most of them are like 1 days, and we see that. That's why there's so much volatility. In 2018, that was long, 23 days. This was bordering on bear. Okay, because it just missed the 20% mark. Then you look at this is COVID. March of 2020, 34% almost. Okay, 60 days. This was the thing. Realize this. When that happened, okay, March 5th, we dropped, okay, and we were down for 6 days, but people started to sell like crazy. This is what we call, it was panic selling. They didn't know what the pandemic had in store for us. We didn't know how long. Everyone was freaking out about toilet paper. Everyone was freaking about wipes and all those things. There was so much uncertainty that people started to cash in their chips. They started to sell everything. 60 days. And the people that stayed in beyond the 60 days, we know where the market went from there. Okay. This is why it's important that we continue to always take an investing mindset, an investor mindset, not a trader mindset. And we don't allow our emotions to run away with our financial decisions. And so when we look at what happened in the pandemic, there was an event, and that event caused something. The question is, did it destroy a company? Listen, some of them really were hurt. Airlines, cruises, hospitality, they really got hurt, and some of them are still dealing with it and struggling. But do we really think that we're not going to figure this out? It's time. They'll come back if they're sound companies. So to think that, when the market drops 34%, like it did in March, to sit back and say, I'm just going to go to cash, I'm going to sell, I'm done, I'm out. It doesn't make sense. But the short answer to the question is a correction is when there's a decline of 10% or more. So they would look at 52 weeks of data, and they would see the market, this is the stock or the market, okay? And they would look at 52 weeks of data, and they would take the highest point, okay? And they would go from that highest point down 10%. And anything beyond that 10% is a correction, okay? And then at 20%, we enter bear territory. In other words, you hear the term bull market or bear market, that's where we enter it. The key here, though, is that we want to see it over consecutive for a couple of data points to make that true. But understand that that's how they measure it, whether it's the S&P 500, the Dow Jones, a specific stock. It's 10% down from its 52-week peak. All right, so great question. So the next part of the question was this. Also, if the housing market is in a bubble with inflated sales prices, then corrects, which affects it by bringing house values down, which, yes. How does that affect rental income? This is really a good question. Does rental income stay the same because people can't suddenly afford to much higher rent, or rent doesn't suddenly go down, or does rental income just rise steadily with the baseline in the market over the long-term time frame? Here's the thing. First off, we need to understand when it comes to real estate is going to be geographically specific. The market here in my location is going to be very different than just 100 miles north of me, and we are in the same state. So understand that some of the things that I'll say will be more principle and general statements. They may not hold true depending on the location or the geography. And each real estate market, you need to look at what's going on in the market. But let's understand something. We are in a time where we anticipate interest rates are going to go up. In fact, I just saw an article on MarketWatch that they talked about I think they said the mortgage rates are the highest they've been since March of 2020 or March of 2021. I just don't recall the date. But in other words, mortgages are going up. That mortgages going up will make buying real estate a little less affordable, depending on how much the mortgage rates go up, which means that demand on the real estate could go down. And when demand on the real estate would go down, conceivably, values would soften. Will they drop or will they flatten? Will they slow down? It depends. It depends on the dynamics of the market. But if we just follow the bouncing ball, if you will, interest rates go up, real estate becomes a little less affordable. That also means that even though market values of real estate might drop, because the interest rates are going up, it still may be something that people can't afford to buy their first property or buy a home to live in. So they still may be stuck with renting depending on the marketplace. And so we need to understand that it's not just the home price, it's the affordability of the payment that starts to play into it. There are some other things that come into play. So if we have a softening of the economy, in other words, we have inflation going on, and one of the inflation hedges is actually to own real estate. But if we have inflation and we don't own real estate and interest rates are going up, there's uncertainty in employment. If someone has uncertainty in their employment, the longevity, the stability of their employment, the likelihood that they're going to buy a house, because that's a long-term decision. I tell my clients and the folks that we work with that unless you anticipate being in the house for 7 years or more, then you don't make a home buying decision. It's a long-term decision. You can't unravel it so easily and everything. So what ends up happening is if there is some uncertainty in their employment situation, they'll tend to continue to rent to have that flexibility just in case they need to make a shift, make a change, or do anything. Because it's very different trying to break out of a lease than it is to get out of a mortgage and do it that way. So you have those elements in place that will the rents go down? Will the demand for renting go down if property values drop? Maybe, but the problem is that if interest rates go up and make buying property not as affordable, then we still will have renters and people won't necessarily buy. Now, does that mean rents go up? Rents have been increasing over time because of the transitory nature of where people were with the pandemic. They just decided to rent. And they weren't prepared to lock themselves in for 5, 7, 10, 30 years into a property. Now, there's a caveat here, because I also see people that are saying, wait, the real estate market's flying like crazy. And I got to get in, because if I don't get in now, I'll never get in, because I'm. And that sounds to me, in my little elementary brain, that we're chasing the market. And if we're chasing the market, we're making an emotional decision. We don't make emotional financial decisions. When your emotions get involved with your financial and your money decisions, your intellect goes down. Okay? That's how I got caught in a Ponzi scheme. That's how I got picked up, because my emotions got involved. I got excited and they knew how to push those triggers. So we don't make emotional decisions, and buying a home can be an emotional decision, especially when you walk into the home and you go, oh, I could see myself living here. Oh, this is beautiful. What has happened here? We walked into this house and we're looking at a 180-degree view of the beach. We're right on the beach. We see Catalina Island. And oh, so when it came to negotiating, I had to keep my wife out of it. And I had to keep my emotions out of it too. Both the emotions of how I love the house and the location and wanting to be by the beach, and the emotions of my wife overlaying on me. Okay. And so that being said, we need to not chase the market. And so often people will rent. Now, I just looked up some stats. And there are some markets in the last November and December that saw declines, like Boise, Idaho, for instance, and San Francisco. All of those markets started to see declines in rentals and rents in certain areas of the market. So there isn't a general statement that says, hey, if we are in a real estate bubble, and I'm not saying we are, but we certainly have been on an accelerated value growth pace. And if that were to flatten out, would that impact rents? Yeah, possibly. But realize this, then rents probably won't decrease quickly, and they probably won't increase quickly because unless you're on a month-to-month basis, many people are on a lease. So rent is set until the lease term is up, and then they'll adjust from there. So that's how I kind of see the rental market. But it really depends on the location you're looking at, the type of property that you're looking to rent or buy, and look at from that perspective. Great question. Then the third part of this question is also, if we don't invest yet or are paper trading. Now, paper trading, and this is one of the things that I recommend to the people that I work with at the very beginning, is I want you to paper trade. In other words, and I use Think or Swim, which is a TD Ameritrade arm, but I'm basically trading. I'm basically investing with monopoly money. I create an account, I buy and sell stocks, I do all of that, but it's not with real money. So it's called paper trading. It's virtual trading. It's like fantasy football, but with stocks, okay? And ETFs or index funds. But the purpose behind doing that is to have you go through your process. Like we have specific investing rules, analysis rules, all those things that come into play. So you go through the process, you execute the trades, you watch the trades, and you get used to it, the process, without the emotions or without the feeling like, oh, I'm lost money. And if you lose money, you lose money. Now you examine it to figure out, what did I do wrong? What did I miss? Is there something? What can I learn from this? And it wasn't real money that you lost, but it gives you the feeling of reality because you're actually trading it in an account and doing it that way. So with that, that's where I want everyone to start. When you're starting to understand and trade and invest, I want you to do it on paper first. I don't want you to do it with real money, because that education becomes far more costly, if you will, when you're using real money than when you're using the paper trading platform. All right. So it says, is it worth turning a small part of it into a real cash investment when and if the correction happens to take advantage of the market sale? When we say when the market dips, that means that certain good companies are on sale. And I want you to hear this for what it is. And that is this. That sounds like an emotional decision. You believe that the market's on sale, and so we have to get in to make it happen. But remember, we showed that the market goes up and down. If we missed the Nordstrom sale this month, we can get it next month. My point is that I don't want anyone making an emotional decision to invest. And so there's some questions that I want to ask. Is that one, for those of you that understand this, we talk about this idea of the wealth priority ladder, which says, where do you allocate your cash? Do you have a comfort fund? Do you have a peace of mind fund? Where are you on your consumer debt? Where are you on your investing, in your retirement and those types of things? And so we don't make a decision to invest until we're at the right spot in the wealth priority ladder. And I did an episode that went through this in detail. I think it was episode 24 where I talked about it in detail. And so you can go through it in that construct and say, look, where am I? If I don't have a peace of mind fund, I don't have a comfort fund, I have a ton of debt, you actually shouldn't be investing no matter how on sale it is. You should be getting yourself on stable financial foundation. If you are past those and a point where you can start investing, yeah, you might look at it, but follow the rules, follow the principles. Make sure that you know that you're making a trade that is logical, that makes sense, and that you can support, and that you're not taking on undue risk, which then leads me to this. Before we ever before we ever make a trade or an investment, we want to understand two things about risk. What is your risk tolerance? Which is another way to say it is, how much of that roller coaster ride can you stomach? Okay. If the market drops 200 points and you can't sleep at night, your risk tolerance is low. If the market skids and you're going, yeah, it's going to come back, your tolerance might be high. Okay. And there's assessments. We have a specific assessment in the Affluence Blueprint that you can go through to understand where you are on that risk spectrum. But there's another piece of this, and that's called risk capacity. Okay. Just because you can stomach it doesn't mean you should. In other words, can you sustain yourself if there actually is a loss? You think you can stomach it, but is it a smart decision? Well, let me give you a for instance. I'm 60 years old. I'll be 61 this year. Okay. My son is 31, will be 32 this year. His capacity, his level of tolerance and capacity is probably higher than mine on a couple of avenues. One, he's got a long runway ahead of him. He's got much more time until he decides he wants to get out and retire or whatever. And I don't know that I'll ever retire. But I'm at 61 versus he's at 31. There's a 30-year difference there. Okay? My desire to tolerate risk is much smaller than his. And not because I can't, because I choose not to. I don't need to take on risks because of where we are in our wealth. And that goes then to capacity. We have the capacity to sustain a loss and still not necessarily affect our lifestyle, but I don't have the desire. So in my mind, the capacity is lower. Okay, so we need to look at it through those eyes, and hopefully this is starting to make sense. Then, if we understand our risk, if we understand where we are in the wealth priority ladder, then my next question would be, are you investing with a strategy and a plan? We don't just haphazardly invest. We don't just haphazardly buy stuff because it's on sale. Does it fit the plan to move you towards what we call your affluence vision, towards the trajectory and the destination you're going to, or not? There are plenty of really good investments out there that I'm not in because it's not in alignment with the strategy and the plan that we have in place. So if you have a plan and you have a strategy, then the next piece is, have you done the research and analysis to specifically know what to buy, when to buy it, and if it's a fit for the plan and the strategy. Okay? So it's not an easy question to say, should we just put it into cash? No, I think there's more work to be done if you want to do it strategically and smart with a long-term view. And then that leads to and I think it's the same answer, but this last piece of the question says, should we all invest a small amount in an ETF or low index fund and just leave it there to run the gamut of the market movements, especially after time of correction, whenever that is, because the value will go up? So the biggest thing I'm going to say here is that all is a generalization, which makes it typically not true. And everything we talked about just in the last piece, I think applies. Could you haphazardly just invest into an index or an ETF fund, small amount? Yeah. And if it's a small amount, you're probably not risking a lot. And is it a big deal? No, and they're going to leave it for a while. Great. But I'd rather you take the time to understand, to come up with the right strategy, to come up with the right plan, to know where you are in the wealth priority ladder, and to make a decision that fits into moving you forward towards your financial goals versus I'm just going to buy it because it's on sale. Okay? Because the market goes on sale. In other words, it goes down 1/3 of the time. So if you didn't catch it now, catch it the next go around when it goes on sale again, when there's another correction or when there's another drop or something. It will come back around. You're not missing a once-in-a-lifetime opportunity. So what I would do is be very methodical, very systematic, and I'm saying this repeatedly because when I wasn't, that's when I got hurt. It's when I lost money. That's when I got into bad investments. That's when I made bad decisions. Now, I don't know where each of you are at. So I think it is important for you to evaluate that, to educate yourself, to make sure that you're on the right path, that you're making the right decisions in the right order to maximize the probability of wealth creation and asset preservation. Hopefully that helps. All right. These were great questions. God, they were great questions. And if you have other questions or things that come up, do me a favor. Send them my way. Let's get them answered. Let's keep you moving forward. Let's keep you rocking and rolling. All right. I hope you found this of value, and if anything comes up, let me know. In the meantime, always strive to live a life that outlives you. Cheers.